Hello, everybody. It's April 20th at 11 a.m. Eastern Standard Time. It's the Dr. Ed and Maximus show. Max is here, but I don't know how long he's going to stay. It's taken me five of these treats to get him to stay here for a while, but I don't know. I guess he's kind of gotten used to the talks here, and he figures there's more interesting things to do, and he moves on. But anyways, I'm not going to give any more treats. Um, Speaking of treats, the market's been giving us lots of treats. The S&P 500 is up over 12% since it bottomed on March 30th. Kind of proud that on March 31st, after the market had a great day on that Tuesday, it was Monday that the market bottomed on March 30th. On Tuesday, we had a big, I think it was a 2.5% move to the upside. And that evening, we sent out a quick takes saying that we thought that Monday was the bottom, and partly had to do with the action of the market, partly had to do with the geopolitical background. It was becoming clear that President Trump was looking to put together some sort of exit ramp, off ramp from this geopolitical situation in the Middle East. And also sentiment was extremely bearish. It got down the bull-bear ratio that Investors Intelligence puts out. But I think I've got my microphone over here. We've been hearing right. Let me make sure that I'm using my famous Yeti microphone here. Yeti microphone, Yeti. Okay, good, good. You know me, this is a one man and one dog show. So, okay. Thank you. I got a message that you can hear me fine. This Yeti really is a Marvel contraption. It's brought me much joy in my video taping, and very rarely have I had a problem with it. The main problem is me when it comes to doing these videos. But anyways, I digress. Let's talk about the treats. So it was March 31st in the evening. There he goes. He's bored. Hope you're not leaving me, husband. Let me have a look here. This is a very nice turnout, actually. Appreciate it. The market has had a huge move. I think it's one of the biggest or the biggest move from oversold to overbought. I think that's especially true for the Nasdaq 100. And we mentioned that in the quick takes last night. So it's really quite impressive, and it's almost kind of back to pre-war market action here. Technology is back in. Magnificent Seven is back in. The growth is back in. Momentum has surged. Value is lagged behind. Of course, value includes energy, and energy trades like a commodity, trades off the price of oil. Price of oil has come down. I mean, that's really been one of the truly remarkable developments in this situation, is the oil market has signaled that one way or another, this too shall pass, and not in a matter of months, but in a matter of weeks. And if that's the case, then I guess all the strategic petroleum reserves that have been drained here are helping to keep oil prices down. But you would think that given that the Middle East has a very long history of being an area of violence and conflict and wars, going all the way back to biblical days, you would think that the markets would be a little bit more, have more of a risk premium, that things could still go very wrong. And clearly, we don't have a peace deal. We don't even know if there's another round of negotiations. It seems like the White House is flying some negotiators out to Islamabad, but it's not clear that the Iranians are going to meet them there. And then it's, we kind of raised this issue from the get-go, is that we're dealing here maybe, not with the mullah power structure that we had before Khomeini was assassinated, but we're now dealing maybe with the Revolutionary Guard, and who knows what kind of civil wars going on among the Revolutionary Guards between those who want to die for the cause and those who don't want to die for the cause. Um, and it may very well be that it's hard to get a deal with Iran since there might be actually no cohesive, coherent leadership to make this all work. But maybe the markets kind of looked at the history of commodity prices and concluded that high commodity prices solve the problem of high commodity prices, particularly oil prices. Oil prices typically spike up pretty close to where they're going to peak when the spike first occurs, and then in a fairly short period of time, the prices come down. Now, not every previous price spike is analogous to what we're seeing right here. The closing the Strait of Hormuz is obviously a whole new geopolitical development. But maybe the perception is one way or the other, the oil will get out through Saudi pipelines. Maybe there'll be tanker trucks that make the long haul to bring the oil out. And then maybe, well, certainly for the U.S., we know that the U.S. is much less energy intensive. We know that the U.S. is a net exporter of oil, and I guess Trump is scrambling to try to get the U.S. to produce even more oil. Not so easy. The rig count hasn't gone up. It's still down. Maybe he figures that he can get more oil out of Venezuela, maybe out of California. Might be easy. It may be easier to get oil out of Venezuela than out of California. We'll see how that all plays out. But at any rate, it's certainly better to see the market the way it's been of late. And I haven't seen it. I saw it like 5 minutes ago, and pretty impressive. Price of oil was up last night. I think it was up $5. I think it was like around $95 a barrel. And then this morning it's up about $4, so still under $100. Um, and the fact of the matter is that's pretty impressive, given that for all the talk about the strait being open, it's pretty clear to see how quickly the talk can go the other way and the reality can go the other way. Let's look at some of our favorite charts here that we often turn to. Um, let's see if I can find them first of all. That's always a challenge for me. I don't know why. Let's go here. Okay, so I usually like to start with the market call. This is what we do on uh, over the weekend. Usually put it out Sunday night in the quick takes. If you haven't noticed, Yardeni research just keeps getting better and better. We've got two contributing editors now. Toby Hurst is stationed in Melbourne, Australia, so he's our Australian office. You know that William Pessock's been with us for quite some time, and he's our Tokyo bureau. And then Elias Grippentrog is in Amsterdam, and he's joined us as a contributing editor. So we got a lot of firepower when it comes to writing and analysis and researching, and sticking to our knitting. This is what we do, and we want to do it better and better. Also, Steve Ripka, our one-man IT department, has done an amazing job in re refreshing the website. And if you haven't seen it, you should go have a look at yardeni.com. Maybe if we have a few minutes left, I'll take you through it near the end of the show here. But the animal spirits are back. They've been back since the market bottomed on March 30th. It's been a heck of a rally. You can see this is the bar chart of the performance of various key indexes in the S&P in the market, including obviously the S&P 500 up here, up 12.3%. Not too shabby for like what 3 weeks worth of work. Small cap is up, mid cap. It's actually been. I know that everybody's focusing on the Magnificent Seven being the leadership group, but it's been a fairly decent double-digit returns almost across the board until you get into value land. And once you get into value land, the returns aren't as exciting, but they're still positive. I think the only negative thing here is Dow Jones 15 utilities. It's actually kind of flat. Big increase in Dow transports leading the way here, obviously very sensitive to oil prices. Um, and to maybe the perception that, hey, look, markets somehow or other have been dealing with Russia's invasion of Ukraine. Maybe now, somehow or other, it's hard to imagine, but somehow or other, the market comes to conclude that even if the Middle East continues to simmer, if not boil, that somehow or other that the oil will get out and the fertilizers will get out and so on and so forth. Then again, maybe the market's figured out that if Trump doesn't get to drive off the exit ramp pretty quickly, he's going to get he's going to deliver on his threats to really put Iran back in the Stone Age. I mean, that's still a conceivable scenario. It sounds like a lot of bluster and part of the uh, art of the deal, but we'll see. Um, Meanwhile, as we've documented before, geopolitical crises tend to be buying opportunities, and bottoms are usually made before the end of the conflict, and sometimes when the conflict looks at its worst. Market looks ahead. It's a discounting mechanism. We've had this amazing surge in the Invesco QQQ, and again for the Nasdaq 100, it's been I think it's in the 40 years that this is available. Toby came up with this fact that the move from oversold to overbought is unprecedented. Um, Also, well, I don't know if it's unprecedented, but it's sort of. I mean, it certainly looks like the analysts have not gotten the war memo. It certainly looks as though companies aren't getting back to analysts and telling them, there's a war going on, and it could have adverse consequences for our business. We might not be able to get the fuel we need. It might affect travel. European airlines are saying that they might run out of jet fuel. We might run out of fertilizer. There may be supply chain disruptions resulting that nobody's even thought about when it comes to this the shutting off of the Strait of Hormuz. But you know, the analysts, meanwhile, if you look at their 12-month their expectations for earnings over the next 12 months, forward earnings on a 12-month basis, you're seeing more companies showing positive comparisons, which is what they typically do when we're not in a bear market. Bear market, bear market, bear market, and these things come down very, very hard. This is actually going up, kind of the previous cyclical highs. So the earnings momentum, breadth, I should say, looks really, really good. And then I love these charts. I don't know if you love them, but I do. Joe Abbott came up with them. We worked on them together, and we're constantly updating them. And this gives us a weekly view of what analysts are thinking with charts. Much easier for me to interpret things with charts than with tables, but we do both. But if you can do it in a chart, why not? And what you're seeing here is the 2027, the 2026. Forget about 2025, that's over. But the analyst expectations are still going up. Um, and obviously, the earnings season's already started, and it's starting out pretty good. Yeah, there shouldn't be that many upward surprises because the analysts have been pretty optimistic about the first quarter, despite the war. But here, the estimates for this year and next year are going up. So forward earnings is at an all-time record high of $341. Analysts are looking for 325 for this year and 379. Usually we like to kind of stay with the cool crowd, the bullish crowd, and I don't know. It just seems a little bit too bullish, but maybe we should get with it. Obviously, after all, we are the roaring 2020s crowd, and so we're still using 310 and 350. But I'm going to have to get together with Joe. You know what? I'd like the war to be over. That would kind of be helpful. Call me old-fashioned about these things, but I think once the war is over, maybe the market's a little bit too much ahead of my geopolitical senses. I'll raise the 310 to closer to 320 and the 350 closer to 370. But even 310 and 350, that got us to 7,700 on the S&P 500 by the end of this year. Still gets us to 10,000 by the end of the decade. So we're bullish, but it'll be kind of ironic if we're not bullish enough. Um, Speaking of bullish, the analysts are bullish. You can see that they did lower the growth rate for the first quarter there, which is what they typically do going into a quarter. You can see there's a history of analysts as they get near a quarter. I guess they get some whispering from their companies that are in trouble. The companies that are in trouble don't want all the bad news to get out all in one shot and cause a big drop in the market. So the analysts start to lower their numbers. And then you get the earnings hook, which is what we've had in the past. But in this case, the earnings hook has already occurred really before the earnings season, and the expectations are pretty solid at over 12%. Maybe if we get an earnings hook, that'll be again quite bullish from an earnings perspective, and maybe it's more like 14%. And meanwhile, again, notwithstanding what's going on in the world, the analyst expectations is double digits earnings growth for the next 3 quarters. So we thought last year was a good year. This year is turning out to be just as good, if not better. And you can see this is our famous earnings squiggles, where we show you forward revenues, but we multiply forward revenues by different margins. Forward margins, let's say of point 0.8, zero point 0.1, or 10, 8%, 10%, 12%, 14%. Look at this. We're going towards 16% as what analyst expectations for revenues and margins are doing. And you can see also that the pace of revenues is going into record territory at a faster pace. I guess it's technology revenues. I guess it's energy revenues. But all in all, this is kind of a good measure of the global economic activity, right? Because U.S. companies, S&P 500 companies, certainly do a lot of business on a global basis. So the global economy, just according to this, really isn't flinching at all. Then we've got this over here. We've got the S&P. This is another squiggles analysis where now we're looking at the squiggles for earnings. Up here it was forward revenues times margins equals earnings. And so you can see that forward earnings were rising along with both revenues and profit margins. I mean, talk about everything going right on the earnings side, or at least analysts thinking so. And then when you look at forward earnings to get the stock market, you get forward earnings, again, reflecting the acceleration in revenues, reflecting the increasing expectations for profit margins. And lo and behold, we're at an all-time record high in the S&P 500 with a multiple of around 21, still shy of the 25. Pretty remarkable stuff. And again, we shouldn't be that surprised if you've been with us with the Roaring 2020s ID. And the Roaring 2020s ID seems to be shared with Kevin Warsh, who will be testifying, I think, on Wednesday. And my new colleague in Amsterdam has joined me in analyzing. So Elias has joined me in analyzing what Warsh is all about. And we've written, even before Elias joined us, we've written about Warsh as being basically a supply sider, and of the view that productivity is already making a big comeback. AI is a big part of his story. We've been talking about productivity making a comeback since 2020. August 2020 is when we put it in print. And we said AI could be one of the stories, but we talked about brain technologies. don't make me uh, try to remind myself what brain stood for. I think it's biotechnology, and R stands for something, and A is artificial intelligence, and so on and so forth. But anyways, there's a lot of technologies. What really is the story is there's a shortage of labor, and we anticipated that even before the Trump's very strict migration policies, and the shortage of labor is forcing companies to figure out ways how to make their workers more productive, and they're doing that. And just by coincidence, AI came on stream, and that is a powerful force. We use AI all the time. I use it all the time as a research assistant. We obviously don't always trust it, so we do fact check all the time. We've become prompters and fact checkers. We don't have to be coders because we have been using the Claude to code stuff for us. And on the website now, we've got some AI tools that you might find of interest, and they talk about 5, 10 minutes of coding time to put together, thanks to Claude. Again, I'll try to leave a few minutes just to look at the website again. But this is a chart on productivity. The productivity growth is back to kind of its historical average norm of 2%, but we think 3 to 4% is very possible over the next over the rest of the decade. And apparently, so does Warsh. And Warsh thinks as a result of that, we're going to get lower inflation. We should look past the oil shock. We shouldn't be too concerned that the super core services inflation rate seems to be kind of stuck around above 3%. All that is transitory, and what's permanent is going to be a productivity boom. Hey, we love this story. I mean, it makes well, we've been buying into it for a while, but Warsh is arguing that as a result of that, the Fed should lower interest rates. And I'm not going to use the word we. I'm going to use the word I because I'll take the blame here. Yardeni Research has been wrong about the Fed. I have been wrong about the Fed since the Fed started to ease. This is the Fed funds rate. But I was really giving the Fed advice, and they just wouldn't listen to me. It's probably another reason why I wasn't even considered to be Fed chair. It's because I was arguing that the Fed shouldn't lower rates, and we know where the administration stands on all that. So I never got a call. But that's all right, even though I've offered to do the job for half the price of what it costs to run the Fed, but they've never taken me up on it. But look, my argument was there's no reason for the Fed to cut interest rates because the economy is doing well. Inflation is moderating, but we're not at 2% yet. And oh, by the way, if you cut rates, the bond vigilantes, I have some kinship with the bond vigilantes. I'm sort of their anthropologist, their psychologist. I have some sense of what they're thinking. And I said, you cut rates and the bond market may not go along with you. And sure enough, the Fed cut rates by, what was it, 100 basis points in 2024. And the bond yield, as I suggested, went up, and it went up by 100 basis points. So is that really easy? Especially when the mortgage rate also went up. Then things kind of meandered downwards. And once again, the Fed didn't listen to me. They cut rates, and this time around, the 10-year just kind of like pretended like they weren't there. So I think that was a bit of an offset to what they were doing. But they did what they did. It's done. I don't see much reason for them to lower rates more. And oh, by the way, the rest of the committee that Warsh is going to have to interact with doesn't seem to be inclined to think that more rate cuts are necessary. So that's kind of our position. Our position has been that this was the great abnormal following the great financial crisis, was having bond yields go down to 0.5. We're back to a normal level of bond yields for a normal economy, with actually not that normal. I mean, the economy is been growing solidly. And capital spending has been extremely strong. The whole AI revolution is going to require more capital spending, more borrowing. And why would you possibly expect that the bond yield is going to come down to accommodate that, as opposed to provide a reasonable financing for that? Having interest rates that aren't allocating capital properly is a mistake. Meanwhile, John Williams, who heads up the Federal Reserve Bank of New York, Um, Suddenly got a little bit of a cough here. Maybe I'm talking too fast. New York pace. Anyways, this is a chart that Elias brought to my attention, which is the parallel movement between labor share of national income, which is the red line. And you can see the national share was kind of around here. What was that? Red, 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 red. Yeah, so it was like about, oh, this is a different kind of measure, but it's not quite lines up with the national income, but the trend is the same. It's what the Fed came up with, Williams came up with. Anyways, the basic story is if the labor share of national income declines, and the share goes obviously somewhere else, like the profits, uh, yeah, capital tends to save more. The capitalists tend to save more than workers, and so that should bring the natural interest rate down. The problem is that not only do we have the labor share issue, we also have the fact that baby boomers are retiring with a tremendous amount of net worth, and we think the savings rate on the personal basis is going to go negative. So that means less savings, not more savings into the system. And we are predicting, yes, indeed, that the savings rate's going lower and could actually turn negative in the next few years. And you can see that, yes, profit share of national income has indeed increased. But then again, companies have gotten so capital intensive with regards to spending on AI that they still have to borrow money. So that's kind of what I wanted to run through in the charts. Let me, I'll do the website another time. Take a look at the website. There'll be a test on that next week. We'll look at it together. Maybe I'll start with it. But okay, Matthew. Good morning, Dr. Ed. Any thoughts on recent trends in business formation and its effects on labor? Always appreciate your insights. Yeah, Matthew, that's a good question, and one that we've written about, thought about quite a bit, and that is uh, to say that to look at national income and look at labor share all by itself, I think misreads the fact that America is a very entrepreneurial country still, believe it or not. We've got 30 million proprietorships. I'm a proprietorship, and my income is included in something called proprietorships income. It's as though I'm not a laborer. I'm not in labor income, and I think I work for a living, and I think proprietorship income should actually be included in labor share of national income, and we'll do some writing on that score soon. Also, landlords, there's something called rental income, and landlords are not counted as being a part of labor income. I know a lot of landlords that work quite hard at what they have to do, and but that's not counted, and it probably should be. Um, and then, of course, there is non-labor, truly non-labor income, interest income and dividend income, which is a different animal, obviously, than labor share. But then again, people over their lifetimes, particularly the baby boomers, have worked hard over the years, and they've been earning labor income, wages and salaries, and they've been saving, they've been investing that, and they've been able to supplement their labor income with interest and dividends. So it's not as though labor hasn't shared in those kind of sources of income. So it's more complicated than the simplistic notion that workers of the world unite. All you're getting is wages and salaries and getting exploited and that whole story. The Wall Street Journal, this is William, the Wall Street Journal had an article opining that parts of the market are thinking that the huge run-up in earnings are more of one-time events due to data center build-outs and energy earnings being temporary. Yeah, I saw that. James McIntosh, very, very smart fellow, writes a column for the Wall Street Journal. Um, I mean, he's partially right, but there's a lot of moving parts to earnings, and when we look at earnings, especially S&P 500 earnings, we do look at the sectors, and there's a lot to like. It's not just to drivers that are temporary in nature. Eva, hello, Eva. It would be a dream if you could get AI to read your morning briefings and have that option embedded in an email. If at all possible, reading and driving is hard. Don't have a Tesla yet. Uh, we've been actually thinking about Eva, and probably we will have at least reading option where AI will read it to you. And if you don't mind my haphazard voice, I guess you can choose my voice, but it'll probably be better with a British accent or something like that. Denise, good morning. Are you Denise? Glad you could join us. Good morning. Are you predicting the decrease in national savings rate due to baby boomers spending their savings in retirement? This whole conversation has actually led Elias and I to that area of that frontier of research, and we will be doing more work on that. But I think as a kind of a knee-jerk answer to your question, yeah, that kind of makes sense. And by the way, therefore makes us probably more dependent on foreigners to finance our deficit in that regard. And for all the talk about foreigners not doing that, they actually have been doing that. And we've discussed that in the past. Okay, Eva, I get it. And I don't want to miss a word in the morning. I appreciate that, Eva, and thank you very much. Yeah, so we'll try to use AI to make things more efficient for all of you. If you have just a brief second here, let me see if I can very quickly take you to the wonderful world of Yardeni Research AI. And bingo, bango. Here we are, independent financial research analysis. Look at all the wonderful things we have for you. We got these tools. So when the FOMC minutes come out, if you want to compare the March meeting to the January to the December meeting, this uses AI to identify the hawkishness, the balance, and the dovishness, and then it does it by various issues. We use it as a research tool, and we're sharing it with you. We're not hiding these things from you. There's a private credit monitor. Melissa Tagg is, I call her Claudette because she loves to use Claude. And she's just a whiz kid when it comes to all these things. By the way, you can look for sectors also. We're going to do quick takes on sectors, AI generated quick takes, and then we'll actually use this as a research tool to write our versions. And Toby and Elias and I are branching out to do more sector work. So again, the whole idea is to work harder by working more efficiently with the AI tools. Um, what other little? Oh yeah, this is a gem. This is Steve Ripka's put together some amazing. This is search tools. So this shows you just put in. I don't know. What do we want to do here? I don't know. The only thing that comes to mind is earnings, so we'll probably get plastered with a whole bunch of charts. So this, you could just fine tune your search and it'll find charts for you. You could do it by categories of what we publish and so on. Um, Over here about is about resources. If you want to read my books, they're all available um, uh, to you in PDF format, open source. And then this, I just noticed this myself on resources. This is my movie reviews, and now we got cool little images on these things, and you can actually see them by ratings. You're reviewed. I guess there's a search engine here. I haven't looked at it yet, but I'm sure there is. And that's yeah, you have to remind me. We did see the movie The Secret Agent, which obviously I didn't care for, but we've got the wrong image here. We've got to put the correct one. So, anyways, that's just a little taste. Of course, the big resource is the, um, the charts, which you can browse on your own. And you can also create, or we can, David, my son, David Yardeni, is a whiz kid who's created most of these charts, and he can generate chart books just for you with your own URL that'll automatically update. Anyways, that's a quick update. As you can see, we're uh, we're raring to go, trying to get better and better at what we're doing using AI and some bright new talent to move us into the future and to infinity and beyond, as Lightyear said. Thank you very much, everybody.